Right now, Opendoor Technologies, trading under the ticker OPEN, is priced at $6.13, marking a modest intraday gain of 0.33%. But to look at that fractional percentage move is to completely miss the seismic tug-of-war happening just beneath the surface. The common narrative, the expectation repeated in forums and on financial news, is that Opendoor is a simple binary bet on the housing market. Interest rates fall, Opendoor rises. The Federal Reserve tightens, Opendoor collapses. It's an easy story to tell, but it's dangerously incomplete. The reality is that the future of this company is not being decided by Jerome Powell alone, but by a far more complex and fascinating battle being waged within its own algorithms, its contribution margins, and its quiet strategic pivot from a capital-intensive home flipper to a distributed, asset-light real estate platform. This is where the real story lies, and it's a story that most of the market is currently ignoring, choosing instead to focus on the daily noise of macroeconomic headlines. Let's ground ourselves in the recent volatility because it has been a crucible for investor sentiment. The stock has been a battleground, with heavy volumes suggesting a significant clash between institutional buyers and sellers. We've seen days with trading volumes exceeding 84 million shares, a staggering figure that points to major position adjustments. While some retail investors, perhaps using platforms like Robinhood or SoFi Invest, have been drawn in by the stock's spectacular multi-100% run-up from its lows, the institutional filings tell a more nuanced story. Firms are actively reevaluating their positions. While some legacy holders have trimmed their stakes, new money is clearly flowing in, betting on the long-term vision. This isn't the chaotic, meme-driven frenzy that characterized other speculative stocks. This is a calculated, high-stakes debate about the fundamental direction of the U.S. real estate market and whether Opendoor has built a defensible moat. This is the kind of analysis that goes beyond simple charting on a Fidelity mobile app and requires a deeper dive into the company's operational reality, something we're going to do right now. The primary expectation of an investor looking at Opendoor is that its success is dictated by its ability to buy low and sell high, just on a massive, algorithmically driven scale. This is the iBuying model in its crudest form. The reality, however, is that Opendoor's survival and future prosperity hinge on its contribution margin per home sold. This metric, which accounts for the direct costs of acquiring, holding, and selling a property, is the true indicator of the health of its core business. In recent quarters, this margin has been under immense pressure. The company faced a difficult period where it was forced to sell off inventory acquired at higher prices into a cooling market, leading to significant write-downs and spooking investors. Yet the most recent earnings reports have shown a stabilization and even a slight improvement in this key metric. This isn't because the housing market suddenly roared back to life. It's because Opendoor has become ruthlessly efficient, tightening its buy box, refining its pricing algorithms with mountains of new data, and reducing its average holding period for properties. This internal operational discipline is the reality that contradicts the overly simplistic expectation that the company is merely a passenger on the macroeconomic wave. It is actively steering its own ship through turbulent waters, a crucial distinction for anyone considering an online investment in the proptech space. To understand Opendoor, you must understand its business. The company pioneered the iBuying model, offering homeowners a near-instant cash offer for their property, taking on the hassle of repairs, showings, and closing uncertainty in exchange for a service fee. This revolutionized a segment of the market by providing liquidity and convenience. For years, the narrative was about rapid expansion, capturing market share at all costs, and disrupting the traditional real estate agent model. That was the old expectation. The new reality is a hybrid approach. Opendoor is evolving, realizing that being a pure iBuyer is incredibly capital-intensive and exposes it to immense balance sheet risk during market downturns. It is now aggressively building out a marketplace model, partnering with agents, offering its services à la carte, and developing new products like Cash Plus, which provides sellers with upfront liquidity while still allowing for potential upside when the home is resold. This strategic pivot towards an asset-light model is a direct response to the market's recent punishing lessons. It's a move that many investors, still fixated on home sale volumes, have not fully appreciated. This shift could fundamentally change the company's risk profile and pave the way for a more sustainable, profitable future, making it a compelling case for those using sophisticated platforms like interactive brokers to manage their individual brokerage accounts. Looking at the broader environment, the U.S. housing market remains in a state of flux. The average 30-year fixed mortgage rate is hovering around 6.5%, a level that has significantly cooled the frenetic activity of the pandemic years. However, inventory remains tight in many key markets, putting a floor under prices. This creates a challenging but not insurmountable environment for Opendoor. The expectation is that high rates will continue to suppress transaction volumes across the board. The reality is more complex. Opendoor's value proposition, speed, and certainty can become even more attractive in a slow, uncertain market. Sellers who need to move quickly for a job relocation or other life event may be more willing to pay for Opendoor's convenience rather than risk having their home languish on the market for months. This is a powerful counter-cyclical driver that is often overlooked. Comment below with your prediction. What do you believe the peak 30-year mortgage rate will be before the Federal Reserve begins a sustained easing cycle? Your answer reveals your own macro outlook, which is critical for valuing a name like Open. The future outlook for Opendoor is a tale of two potential paths, a classic tension between expectation and reality. The bearish expectation is that the company will continue to burn cash, that competition from traditional players and other tech-forward brokerages will erode its margins, and that a prolonged housing downturn will ultimately prove its model unsustainable. Analysts at firms like Keefe, Bruyette & Woods and Citigroup have recently issued cautious or outright sell ratings, pointing to these very risks and setting price targets far below the current trading level. They see the stock surge as untethered from fundamentals, a dangerous bubble waiting to pop. This is a credible risk that any investor must seriously consider. You cannot simply use a basic Robinhood stock trading app and hope for the best. A deep understanding of the financial headwinds is essential. The company's own guidance for the upcoming quarter suggests a year-over-year decline in revenue, a fact that gives the bears significant ammunition. However, the bullish reality, the one that the market is currently pricing in, is far more compelling. This scenario sees Opendoor successfully navigating its transition to a more diversified capital-light platform. In this future, its vast repository of housing data becomes its most valuable asset, allowing it to price risk more accurately than any competitor. Its partnerships with agents and builders create a powerful ecosystem, generating high-margin revenue streams that are not dependent on its own balance sheet. The stock is no longer just a leveraged play on home prices, but a call option on the digital transformation of the multi-trillion-dollar real estate industry. If they can achieve even a fraction of the market share they are targeting with this new, more resilient model, the current valuation will look like a historical bargain. This isn't just about iBuying anymore. It's about building the definitive online platform for residential real estate, a goal that requires robust investment help and strategic foresight. Success would place it in the same disruptive category as a Tesla stock or an Apple stock, companies that redefined their industries. In conclusion, the story of Opendoor Technologies is a masterclass in the divergence of market expectation and underlying reality. The surface-level expectation is that of a high-risk iBuyer, entirely at the mercy of interest rates and housing prices. The deeper reality is a company in the midst of a critical strategic evolution, leveraging its technological edge and market position to build a more sustainable and diversified business model. The recent stock volatility is not random noise. It is the market grappling with these two conflicting narratives. The massive trading volume reflects this fundamental disagreement among major financial players. While significant risks undoubtedly remain, particularly concerning the path to consistent profitability and the execution of its platform strategy, the potential reward is equally substantial. The ultimate trajectory of Opendoor's stock will not be determined by the next CPI print alone, but by its ability to prove that it is not just surviving the current housing cycle, but is fundamentally